Okay, good afternoon, 2:30 on the dot. Let's get started, guys. So I'll quickly touch up on your case study 2. My voice is clear right at the back? Yep, all good? Excellent. Okay, so case study 2 is now uploaded on Blackboard. All you need to do with case study 2 is read the situation. You've got enough time, okay? You've got more than a month to attempt. Okay, no more talking, please. You got more than a month to attempt your case study 2, so you got enough time. Why I did it on a purpose, basically, and the purpose was you've got a second tuition-free week that's coming up, right? And so maximum word limit is 900 words. There's no plus minus, or rather there's no plus, there can be minus. I'm happy with any minus, okay? But I'm not happy with any plus. Because when you talk about a memorandum, it's kind of a brief cover page where you're trying to basically signify the most important things that you've identified in your assessment. You don't do storytelling in a cover page. Okay, so that's what a memorandum is. It's kind of a business communication being put forward in a very effective manner. So maximum is 900 words. Minimum, it could be anything that you think is appropriate. Okay, you can come down to whatever you think. If you can fit your answer in 500 words, I'm happy. 600, I'm happy, but 900 is the top cover, okay? So when you prepare your memorandum right now, what can you actually do with your assignment, with your case study? What you can do during your tuition-free week is, number one, read the assignment very carefully. Number two, identify 3 accounts, okay? You got to identify 3 accounts which you feel are at the highest risk of material misstatements. Any 3 accounts you feel are at the highest risk. Once you identify those accounts, please give me the reasons on why you've identified those accounts in your memorandum. What components of the audit risk model? Okay, when I say components of the audit risk model, I mean how are your inherent risk and control risk factors associated with those accounts? Because first you determine your assessment of inherent and control risk, and then detection risk follows, correct? Because detection risk is based on your inherent and control risk assessments. So you can even identify components of the audit risk model that are getting affected. And finally, for each account that you've identified, please give me the key assertion, okay? It could be more than 1, a maximum of 2 if you feel, but key assertion, I would like you to stick to the primary, the key, the topmost assertion for that account balance or whatever account you've identified, the key account. So 1 is ideal, okay, at least 1 assertion I'm looking for. If you feel another assertion is also relevant, give me another assertion. But for each account, I would not want to see more than 2 key assertions. If you think 1 is appropriate, then just give me 1 assertion. If you think 2 are there, give me 2, but with reasons, okay? So that's part A, and part A you can still do. Part B, you can do a part of part B. You can identify the audit plan. That means you can talk about your audit strategies. You can talk about what type of procedures you're predominantly going to be using, and that's about it. If we go on and read part B, recommend specific audit procedures, you could maybe attempt it a little bit, but I would say wait, because we've got chapter 9 coming up when we return back from the tuition-free week. Chapter 9 touches heavily on substantive procedures, the different accounts, and so on. And that's where I introduce a lot more substantive procedures, or maybe the same substantive procedures I've introduced before, I'll introduce those again in greater detail. Let chapter 9 get over, okay, in my lectures. Then complete your risk procedures that you need to identify, which is part B. But other than that, you're okay to go with part A. You can always keep making changes because you've got enough time. So please attempt part A. I would say please start off on assignment 2 during the tuition-free week. I won't be available for consultations next week. I've put up an announcement on Blackboard. But my colleague Imran would be available. His consultation times are there on Blackboard. So yeah, so that was one announcement. The other announcement that I wanted to make, that's regarding your case study 2. Any questions you have so far for me for case study 2 before you want to start attempting it? Do you have any questions whatsoever? You can ask me right now. That's what I would love. No questions. The other thing is, remember, you've already now done your mid-semester exam, and you know whatever I deliver in my lectures, I want you to go back home and read your chapters only around those areas, what I've delivered. If I've not touched an area in your chapter, then you don't have to worry with those areas. Only the areas I'm delivering, only the areas in your lecture slides, go back home and read in your textbook the chapters that are there in your textbook, but read only around those areas that I have delivered, okay? For example, how many of you honestly have actually gone over chapter 7? How many have done a reading of chapter 7? That's it? Oh, that's sad. If you actually start reading chapter 7, you will basically observe that towards the end, before internal audit department's responsibilities and relying on the work of internal auditor, there was a whole section which talks about computerized controls, okay? I did not touch it in my lecture slides, so you don't really have to go in deep into computerized systems, internal controls, and so on. Only touch those areas, only read around those areas in your chapters, what I have focused on in my lecture slides, what I've delivered in my lectures, okay? So that's my second announcement. And the third one is I'm starting with the lecture. Okay, any other questions you have for me? Other than when my marks are coming up, I've even posted an announcement for that. Okay, chapter 8. Let's get started with chapter 8. Test of controls. Chapter 7, chapter 8, important because I can tell you right now, and I've said this in the previous lecture, that there is a short case study question coming from chapter 7, chapter 8. And that case study question will basically ask you to identify weaknesses in the internal control system, okay? And so on. So basically just try to understand concepts on how you can identify weaknesses in internal controls, what is a strong system of internal controls. For that, chapter 7, chapter 8 will provide you with the basic concepts. Let's get started. Chapter 8, tests of controls. So tests of controls, basically, this slide is more like a revision slide, which we've already gone over some material in the last week. So when you talk about internal controls, the auditor, when he walks into the organization, he first makes a preliminary assessment, an initial assessment of control risk, okay? He initially basically looks at how strong the internal controls are of an organization. Now, you know that an audit process is basically divided into 3 phases. You've got phase 1, which is your planning and risk assessment. You've got phase 2, which is your execution phase, where you basically put your audit procedures forward and gather audit evidence. It's your execution phase. And what was the third phase? No. Third phase is final phase, which is your reporting phase. Okay, so you've got 3 phases. So we start out with the planning phase, we move on to the execution phase where we use procedures, we gather evidence, which is the middle phase, and then finally we have the reporting phase. In phase 1, when the auditor is basically planning, he comes up with this initial assessment of control risk. Okay? He gets an idea of how strongly the internal controls of an organization are working. Now, in order to make that initial assessment, we used chapter 7 last week to determine how that initial assessment is made. When the auditor is making an initial assessment, the auditor is understanding the 5 components of your internal control framework. Okay? The 5 components that are coming from your COSO framework I introduced last week. The framework which talks about, what is COSO framework? What does COSO stand for? Committee of Sponsoring Organizations of the Treadway Commission. I introduced this concept last week. The 5 components of the internal control framework the auditor needs to understand to determine initial assessment of internal controls are, what are those components? Control environment. What is the second component? Entities risk assessment process. The third one was information and communication. The fourth component was control activities, and the fifth one was monitoring. These 5 components we studied in detail last week. The auditor is gathering evidence. The auditor is understanding these 5 components of the internal control framework to determine his initial assessment. Now, once the auditor's initial assessment is there, then what is step 2? The auditor in phase 2, which is the execution phase, starts performing tests to confirm his assessment. In phase 2, the auditor starts using tests of controls to confirm his initial assessment of control risk. That's what's happening in phase 2. In the interim phase, the execution phase, the auditor is using tests of controls to confirm his initial assessment. One more revision point here, just let me get this thing inside, see whether it works, is when you perform tests of controls, okay, and you're confirming your initial assessment, you're checking for 2 things in the internal control system. What are those 2 things? What are those 2 characteristics you're looking for in the internal control system to see if they are strong or not? Number 1, you're checking whether your internal control system is properly designed, okay? Design effectiveness. And what is the other thing you're checking for? Operational effectiveness, right? You're checking for 2 things. What is design effectiveness again? When would you say your internal control system is designed effectively? When your internal controls can correct, prevent, and detect material misstatements in a timely manner. We studied this last week, right? That's your design effectiveness. What is operational effectiveness? What do you mean by operational effectiveness? Your internal controls were effectively applied throughout the period of intended reliance. What was the period of intended reliance? The 12-month period under audit. So you're just making sure the internal controls were effective throughout the 12-month period, the period under intended reliance. So to summarize again, when you perform tests of controls, you check for design effectiveness and operational effectiveness. Both need to be met. Good. Now, when you assess control risk, what are the factors that could suggest that control risk is high, which also means internal controls are not working effectively? We would say control risk is high when, number 1, either controls do not exist. Number 2, controls exist, but they do not provide relevant evidence. And what is number 3? It is more time efficient, cost efficient to basically do substantive procedures. Just doing tests of controls may not allow you to work in a time and cost effective manner. Okay, so these are factors that could basically suggest control risk is high. It's better the auditor relies on his own substantive procedures. If the auditor has to rely on his or her own substantive procedures, which audit strategy are we now moving towards? What do you think? Which audit strategy are we now moving towards if we feel the control risk is high and we primarily have to rely on our own substantive procedures? Excellent, that's good. Predominant substantive approach, okay, that is the strategy. If the control risk was less than high, if the control risk was not high, then which approach? Lower assessed level of control risk approach. Those are your audit strategies. Next, one more important point which we have here is, when you talk about substantive procedures, sometimes, and this is what this paragraph is basically saying, is there could be areas where substantive procedures alone may not be appropriate. I've introduced this before. I said, even when you feel that the control risk is high, you might not be able to fully apply substantive procedures in all areas. And one such area would be where there are routine transactions, okay? Transactions which are recorded in thousands on a daily basis, like sales, purchases, receivables, payables. These are routine transactions. And for such transactions, it may not be time and cost efficient to start using your own substantive procedures. It might be better to still use some tests of controls in these areas of routine transactions. The other thing to remember with routine transactions is that these are highly automated, okay, with very little manual intervention. They're very highly automated, so it'll be simpler, more time efficient to just perform tests of controls. Because at the end of the day, yes, you have a responsibility on determining whether financial reports are true and fair, but you also need audits to be time and cost effective. Now, nature, timing, and extent, again, this is a part of your audit strategy formulation. It all depends on your assessment of control risk, okay? It all depends on the strategy that you adopt. If you basically say the controls are working fine, which audit strategy have you adopted? If the controls of an organization are working fine, which strategy? Lower assessed level of control risk approach. Okay, so what would be the nature? Nature means type. Type of strategy, the type of audit procedures. If you're basically telling me that the controls are effective in an organization, you're basically saying, okay, if the controls are strong, I will use the lower assessed level of control risk approach. Then what kind of procedures are you using under that strategy? Then you will say, I'll mostly be using tests of controls, but use little substantive procedures, correct? That's what you would do. That's your type. Type means type of strategy, type of the audit procedures you select. If you had to come back and tell me after your assessment, controls are not working fine, then what would you do? You will go and adopt the predominant substantive approach and generally use more substantive procedures. So it's the type of strategy, the type of procedures, the type of tests. Second, timing. Gone over this again in previous lectures. Timing means, what are the choices you have? You've got interim testing, that means a few months before balance sheet date, or you've got year-end testing. If you're dealing with a high-risk client, what would you prefer to do? Year-end testing. If you're dealing with low-risk client, you can do most procedures a few months before balance sheet date, which is year-end test, which is year-end, correct? A few months before balance sheet is what? Year-end or interim? Interim testing. So I repeat again, if it's a high-risk client, you do year-end testing. If it's a low-risk client, you do interim testing, okay? So that is timing, that is when would you do most of your tests. And what does extent mean? How much? If you've adopted a lower assessed level of control risk approach, what would you do more? More tests of controls and fewer substantive procedures. If you adopt the predominant substantive approach, what would you do more? Substantive procedures with very little or no tests of controls. So that is your nature, timing, and extent when you're planning the scope of your tests, when you've determined your audit strategy. Now, when you're evaluating the internal controls of an organization, you're focusing on existence, effectiveness, and continuity. Remember how I started off my lecture by saying you've got two steps basically when you talk about evaluating internal controls. You first start off by making a preliminary initial assessment, right? A preliminary or an initial assessment is made first, and then in your second phase, second audit phase, which is execution phase, what do? You confirm your assessment. So when you make your preliminary or initial assessment in the planning phase, that's the time you check existence of controls, okay? That's the time you check existence. Existence is checked in the planning phase when you're making your initial assessment. Then in the second phase, which is your execution phase, when you start using the tests, you start using procedures that's the time you basically test for effectiveness and continuity. So effectiveness and continuity are tested in phase 2 of an audit. Existence is checked in phase 1 of the audit. That's what they're basically saying. Existence basically is checked when you're evaluating the internal controls, which we mentioned in Chapter 7. Effectiveness and continuity when you're actually performing tests of controls. Sufficiency and appropriateness. I think we all know this concept better than our names by now. So when you say evidence is sufficient and appropriate, which auditing standard is saying that? Audit evidence needs to be sufficient and appropriate. What do you think? Which auditing standard? Is there only one student here? Yes, sir. Excellent. ASA 500.6, we are basically saying evidence needs to be sufficient and appropriate, correct? Sufficiency was quantity, appropriateness was quality. And when we were talking about appropriateness, we were speaking about two characteristics under appropriateness, which were relevance and reliability. Now, when you talk about evidence, you should consider these two factors, and that's what the slide is saying. Number one, type and source of audit evidence. When you talk about type of audit evidence, what are the different types we can have? We can have documentary evidence, we can have verbal evidence. These are all different types of audit evidence. Inquiries from management, inspecting documentation. This is all types. What is source of evidence? Where are you getting this information from? Is it internally generated? Externally generated? Okay, that becomes your source. And then finally, because in an audit setting, you need to gather sufficient appropriate audit evidence, you will be doing or performing several procedures, gathering evidence from many different sources. Ultimately, if it's a low-risk client, what should happen? The relationship between, what should happen to the relationship between information or evidence that you've gathered from different sources? What should be the relationship of the evidence that you've gathered from different sources if you're dealing with a low-risk client? Okay, let me frame this in a different way. If we have gathered audit evidence from many different sources, and we find that all this information that we've obtained is consistent, is saying the same thing, but it's coming from many different sources, what would you consider, or how would you consider the client to be categorized under? High risk or low risk? Low risk. If you gather evidence from many different sources, and the information that you've obtained is all inconsistent, what can you basically have an idea about the client? What would you think? High-risk client, okay? So that's what we basically talk about in terms of interrelationship of evidence. If evidence collected from different sources is saying the same thing, low-risk client. If evidence gathered from different sources is inconsistent, high-risk client. Okay. Now here we are talking about impact of documentation on your audit procedures. If we basically got documentation available, then we basically perform the audit procedure of inspection. Inspection means you're inspecting the documentation, you're inspecting an audit trail. If documents are there, the audit trail is visible. Just perform inspection. However, if there is no audit trail available, okay, if there is no audit trail, then can you inspect documents? No, because the client hasn't maintained records and so on. It doesn't have its documents maintained in the appropriate form. If no documents are maintained and you cannot perform inspection, what are your alternative choices? Then you can basically do observation and then make inquiries from management personnel. So you will go to a different path. Relationship between tests of controls and financial report assertions. Now, again, what is the relationship here between tests of controls and financial report assertions? What do you think? Now you perform tests of controls to gather more evidence, to gather sufficient appropriate audit evidence on different types of assertions. When you talk about the internal control system, you talk about the 5 components of the internal control framework. And we went over these 5 components. The first 2 components, which we discussed in the last week's topic, what were those components? The control environment and the entity's risk assessment process. With the control environment and the entity's risk assessment process, it is not easy to relate these components to any specific assertion. Okay, it's not easy to relate these components of the internal control framework with any specific assertions. But with the other 3 components, which were control activities, information and communication, and monitoring, you can easily associate them with different types of assertions because the other 3 or the last 3 components relate to transaction flows. Okay, they are built around flows of transactions, so they can be related to transactions. The first 2 are more generalized, okay? With the control environment talking about management's philosophy and operating style. The second one, entity's risk assessment process, talking about can the entity identify and manage risks in a timely manner. They're more generalized. But with the other 3 components, which were your control activities, your information and communication, and your monitoring, they are more focused to transactions because they're built around transactions and can easily be related to specific assertions. Sales cycle. All of these cycles are very, very important. Understand these cycles properly. When you talk about the sales cycle, you basically, what does the sales cycle include? Sales cycle includes all transactions and events that basically have gone in completing a sales transaction. Okay? All transactions and events which have been included in completing a sales transaction, they become a part of your sales cycle. How does a sales system of a fairly decent sized organization look like? And this slide is basically saying there are different departments within a sales cycle and then different departments within a cash receipt cycle. I will go over these in greater detail by looking at this. It looks fascinating, doesn't it? Just beautiful. Okay. When you talk about a credit sales flowchart, the first thing that you need to understand is segregation of duties. You need to first see that we've got different departments in play here. You've got the order entry department, credit department, shipping department, invoicing department, accounting department, all these different departments performing incompatible responsibilities. Critical to understand that, step number 1, separation of duties. If you find one person is handling 2 or more incompatible responsibilities, it could basically result in misappropriation of assets fraud. It could result in theft. It could result in related party transactions. To avoid all these problems, we've got appropriate separation of duties within the sales cycle with different incompatible responsibilities being performed by different departments or divisions. Everybody happy so far? That's all we've spoken about. Separation of duties. Next, the first step is basically orders being received, orders being taken. Now, there are many different ways in which orders can be taken. What are the different ways? 1, you could have purchase orders mailed out to the order entry department. Another way of taking an order is through an electronic lodgement over the internet. Another way of taking an order is over the phone. If orders are taken over the phone, it's important to note that there must be documentary evidence. Because if orders are taken over the phone and there is no documentary evidence, it's easy to have fictitious orders taken. It's easy to basically lose any details of orders taken because you have no documentary evidence supporting it. So you might just forget about that order and there could be a loss of order. What are the other problems that could happen if you take orders over the phone and you did not document those orders down? So you could have lost orders, fictitious orders could have been taken over the phone, what else could have happened? Wrong details may have been noted, difficult to verify those orders, and as a result, it's important to always have documentary evidence with respect to the orders that are taken over the phone. So, having said that, we've got orders which could be taken in many different forms. What the order entry department does is it receives the order. With the help of the credit department, it decides whether to accept the order, and then finally, what does it also do? Translates the billing and shipping instructions to the shipping department. So it's handling quite a few responsibilities. It receives the order, it decides along with the credit department whether to accept the order or not, and then finally, it translates billing and shipping instructions to the shipping department. Now, an important thing here, an important part, is the credit department plays a very key role, because in deciding whether to accept an order or not, you take the help of the credit department. Now, the credit department might either have a list of approved customers, okay? The credit department might either have a list of approved customers, or the credit department must be performing credit limit checks regularly. The credit department could also be having both these controls in place. That means, number one, have a list of approved customers, and number two, perform credit limit checks on a regular basis. Once those are done and the credit department is satisfied, we know we can accept the order. But there's just one more thing. Before saying yes for an order, you need to check your inventory levels. You can only meet an order or meet the requirements of an order if you know you've got enough of the inventory items with you. If you don't have enough inventory items, you got to say no to the customer, correct? So there are two things basically that need to be satisfied. One, the credit department's approval, and number two, you've got enough stock. And that is what's basically happening. Those decisions are being made before you say yes to the customer. Then what happens is the order entry department, once the order entry department has a green signal, then shipping billing instructions are moved to the shipping department. A shipping order is issued to the shipping department. That is the document, okay? Also remember one thing which I haven't mentioned. The first document that's inputted in the sales cycle, the first document inputted in the sales cycle by the client is a sales order, okay? Sales order is the first document that's inputted into the sales system by the client in a sales cycle. Now, once you're happy, you know that you can provide these items, these inventory items, to the client, or not to the client, sorry, to the customer here. What should you do? You basically send a shipping order to the shipping department. When you send a shipping order to the shipping department, until your items are shipped, that shipping order will basically be maintained in a pending file, okay? A pending file. So you've got a pending file, and until all these items, all these orders are processed, completed, and shipped, all these are recorded in a pending file. That pending file becomes your aged open order report, okay? It's an aged open order report, which you need to review on a periodic basis. Why do you think you need to review your aged open periodic report on a continuous basis? Because I said that the moment you send out the shipping order to the shipping department, there's a pending file that gets created, right? In the pending file or the aged open order report, you've got all the orders which have not yet been completed. And you need to review, you need to monitor periodically all these orders, these incomplete orders in the aged open order report. Why do you think we do that? Why do you think we monitor all orders which have not been completed yet in the aged open order report? Give others a chance too. What do you think? What do you think? Why? Somebody else? Come on. Okay, you. I've made you a representative. Yes. Not at this stage. At this stage, why you basically, we're not talking about an aged receivable report. We're talking about an aged open order report. These orders are open yet. They haven't been closed. They haven't been processed. If you don't review this pending file or the aged open order report, on a periodic basis, some of the orders which have not been completed might be lost. You might forget about those. And that's why this control is important to ensure that all your orders are completed in a timely basis. Okay? So that's why you have an aged open order report. Now, another important control is to have all your shipping orders in basically a closed cabinet. Okay? Your shipping orders need to be very closely monitored, because if your shipping orders are unauthorized, then it could result in unauthorized shipments. It could result in fraud. So these shipping order documents need to be under close supervision. The goods that are also shipped need to be properly inspected, because you don't want unauthorized goods being dispatched, because it could again result in theft and misappropriation of assets fraud. So that's an important control. Always remember, and I repeat, the shipping order documents always need to be closely supervised so that they are not subjected to unauthorized access. Okay? Then what happens? What does the shipping department do? Shipping department basically ships the items to the customers. The moment the goods are shipped, the shipping department issues a shipping notice. Now, shipping notice is different from a shipping order. A shipping order was generated by the order entry department, and it was sent to the shipping department to ship the items. But a shipping notice is issued by the shipping department once the goods are shipped. Okay? Once the shipping notice is issued by the shipping department, then what happens? Remember how we had a pending file, aged open order report file? The items in that basically get eliminated, because now those open order items have been completed, they have been shipped. So the moment shipping notices are entered into the system, the open orders are closed. Okay, so that's again another important check people can do when testing internal controls of the system, is to compare shipping notices against shipping orders. Okay? For shipping orders that do not have associated shipping notice documents, we need to see a mention in the aged open order report. If the items are not there in the aged open order report, then there needs to be an appropriate shipping notice document. Easy or getting complicated? Okay. Just have a read around this when you go back home in your textbook chapters. So once the items are shipped, then basically responsibility moves on from the shipping department to the invoicing department. And what does the invoicing department do? It generates the sales invoice. A sales invoice is a multi-part document. It's got many different copies. The original is sent to the customer. The photocopies are basically circulated around different departments within the organization. That's what the invoicing department does. And finally, you've got the accounting department, which records the journal entry. Accounts receivable, account debit, sales revenue credit. That's where your accounts receivable master file gets updated. So separation of duties, you had the order entry department generating the order, the shipping order, the sales order, okay? All those orders were generated here. The sales order and the shipping order were generated by the order entry department. Credit department helped us to verify credit limit checks. Do we have confidence to make a sale to this particular customer? Will we recover our money or not? Shipping department was the department which issued the shipping notice and cleared off the pending file, the aged open order report. The invoicing department was the department that issued the sales invoice, okay, which was the multi-part document. And finally, the accounting department has the journal entry processed, which was accounts receivable, debit, sales revenue, credit. Your accounts receivable master file is updated. Such a simple system. Moving on. Cash receipts. So credit sale is done. Now we basically have the cash collection time. Now with cash receipts, again, there are quite a few separate functions here. You've got mail opening, you've got accounting. Now, of course, you might think that mail opening, seriously? We live in a computerized era. Why not simple electronic transfers? Of course, they can happen. But there are still companies that receive checks through the mail, okay? And then they basically start off with their recording system. Now with the mail opening, in a cash receipts cycle, we would like to see at least 2 people present when mails are being opened, in which you generally have checks being sent back by the customer, okay? The customers will basically send you a check along with a supporting document. Which document do you think is sent to us back by the customer? We sent the customer which document? Sales invoice, correct? In the sales cycle. What the customer does is the customer tears off a part of the sales invoice, fills up the instructions and details, the amount the customer is paying, sends that invoice back with the check back to the client. So what is that document? What is the tear-off portion of the sales invoice called? You send the entire sales invoice to the customer basically tears off the portion of the sales invoice, sends that with the checks back to the client. What is the tear-off portion of the sales invoice called? Remittance advice, okay? So that is your remittance advice. Remittance advice is basically received in the mail along with the check from the customer, okay? So when people are opening the mail, we need to have at least 2 people out there, otherwise it increases the chances of theft and fraud. Also, the people who are opening the mail need to be different or separate from the people who will have custody over the cash or checks, and that person should be different from the person who is recording the transaction in the financial records. So here we are talking about 3 people performing 3 different responsibilities. 1, person who's opening the mail. 2, the person who has custody over cash and the bank checks. And 3, the person who's going to be responsible for recording the transaction in the accounting records. So once you open the mail, you've got the check, you've got the remittance advice, then you prepare another document called the pre-list of cash receipts. Very critical. You prepare a document called pre-list of cash receipts. It's all there, and that's why after this lecture, I want you to go back and read your textbook chapter around the areas I've explained. All this explanation is there in your chapter, okay? All these terminologies are there in your chapter. Just read around those areas. So basically, once you open the mail, you get the bank check, you get the remittance advice out, then the person who was opening the mail prepares something called a pre-list of cash receipts. What is a pre-list of cash receipts document? It basically includes 2 things. Number 1, from whom are we basically receiving this money? And number 2, how much are we receiving? Okay, that's it. Those 2 pieces of information. Which customer is paying the client? And number 2, how much is the client receiving from the customer? So those are 2 things that are recorded by the client itself, okay? It's their record, the pre-list of cash receipts. It's a good internal control measure. So once you have the pre-list of cash receipts, then where do you think the checks and the remittance advice are basically sent next to? Where do you think it goes next? It goes next to which department? It goes next to, where does it go next? Once you've got the checks, you've got the remittance advice, where do you think we're going to move these documents to? The cashier, right? He goes and prepares the bank deposit slips. And another good control with bank deposit slips is you should see bank deposit slips being deposited on a regular basis. You do not want deposit slips to be lying around because it again increases the chances of theft and embezzlement, misappropriation of assets, fraud. You would want those checks to be deposited, those deposit slips to be deposited on a regular basis. So you basically, deposit slips are prepared, checks are deposited into the bank accounts. Okay. What next happens after that? After that, your remittance advisors are basically sent to who? To this accounting department, and your journal entry is processed. Now what journal entry are you going to process when you've received the payment? What journal entry do you process? What do you debit and what do you credit? You reduce accounts receivables and you debit your cash receipts. So you've got cash receipts account debit and accounts receivables account credit. So that's the journal entry that you basically process. So again, to repeat, there were quite a few important controls here. One thing that you also need to mention and you need to be careful about is that your checks need to be deposited on a regular basis and your bank deposit slips need to be stored away in a secured location. You don't want them to be lying around. It can increase the chances of theft, embezzlement, and so on. Any doubts so far? So this was your cash receipt cycle and this was your sales cycle. Do you need to know these? Yes. Please read around your chapters. Okay, when you talk about these cycles, they are all mentioned there. Spend some time there. Read around these cycles. There are more cycles to come, so the journey continues. Now next, transaction in a revenue, receivables, and receipt system. So now you've got two types of transactions, routine, non-routine transactions. What this slide is saying, when you talk about routine transactions, I mentioned this before, these are highly automated transactions with very little manual intervention. For routine transactions, you generally perform tests of controls because you know these transactions are going to happen, so controls are generally built very strongly around these transactions for companies. But with non-routine transactions, they are not happening in high volume on a regular basis, okay? And as a result, generally the client's controls are weak around non-routine transactions. Your non-routine transactions could be things like sales returns, sales adjustments, provisions for doubtful debts. Okay, the controls around those areas are weak because they are either estimates or they're not happening on a regular basis. And for non-routine transactions, you would generally apply more substantive testing. For routine, it's more tests of controls. For non-routine, it's more substantive testing. Tests of controls for sale, again, what is occurrence now? You guys are all assertion gurus by now, I guess. What is occurrence? Occurrence basically means all your sales transactions have actually happened, all your sales have actually been shipped, okay? So they are all valid sales transactions. All sales transactions have occurred. How would you check occurrence of sales? What would be an audit procedure to check occurrence of sales? Okay, let's not talk about audit procedures right now because we're still doing tests of controls. So just understand this and we'll talk about occurrence of sales in the next slide when we talk about what tests of controls can be performed. So occurrence basically means have your sales transactions really occurred? Completeness, all the sales transactions that are shipped, have they been included in your financial reports? Accuracy is basically reflecting on the dollar value of your transactions. Cutoff, have your sales transactions been recorded in the correct time periods? What was classification? Has your sale been correctly classified? Charts of accounts, proper coding of accounts, and so on. And finally, have your sales been properly presented with any disclosures made? We know all this. Let's look at this. Is that a little small? I think so. So let's quickly look at what this table is trying to say. The table is basically saying, this is the assertion, column 1. Column 2 is what control we would like to see, and column 3 is how would we test it. Okay, so that's what's happening in this table. Assertion, what control we would like to see for that assertion, what the client should be doing, and column 3 is how can we test it. Because what is a test of control? You're not doing your own procedure. You're basically just testing the control the client says the client has. So occurrence. With occurrence, what would you like to see? You would like to see a policy of authorization of credit and terms associated. You would like to see all the sales are appropriately authorized, all the credit terms are approved. That's what you would like to see, correct? How would you test that? What would you do? One simple procedure would be observe. Observe how the credit department is approving customers, okay? Easy procedure? It's not there, but I'm just telling you that's how you test. Observe how the authorization process is actually basically being processed in your credit department. What is the credit department basically doing? Just observe to check and verify their control. What other things can you do to basically test that control of authorization? A good test of control would be take a sample and reperform, okay? Take a sample and reperform. Reperformance is a very important test of control. You're essentially taking a sample of what appears to be subjected to a test of control and you're reperforming the tests. How would you reperform? Select a sample of sales transactions from the sales journal and check for approved or approved authorization. That's it. Check for valid signatures and so on. So just take a sample of sales transactions and check for approved authorizations, signatures and so on. How difficult is that? That's a test of control. You're just testing the control the client says client has. Completeness. All the sales that are shipped should have been included in your financial report. How would you test that? How to check whether everything that has been included has been taken into the financial report? One way is you would like to see your shipping documents, your sales invoice, all need to be pre-numbered. Because if all your source documents are pre-numbered, it's easy to check for completeness. Have these documents been included or not? So all your source documents, your shipping documents, your sales invoice, they all need to be pre-numbered. What do? You test the numerical sequence. Just check whether the numerical sequence is correct or not. So you're basically just testing the numerical sequence. This is what you'd like to see, and you'll further go and test the numerical sequence. Number 3, accuracy. Accuracy is basically talking about the correct dollar value of your sales transactions. What would you like to see? You know that prices of items can change. Different quantities are ordered by different customers. So what would you like to see in terms of the client's internal controls? You would like to see the client perform recalculations and compare the details of the orders with source documents. What are these details of the orders? Quantities, price, and so on. They need to be compared for every different customer. What do you think could be a test of control? That's what you would like to see. How would you test that? One simple test, observe whether recalculations are happening or not. That's it. Stand at the department and observe whether recalculations are happening or not. That's one way. What's another way to test the control? Is to basically take a sample of transactions and check whether these transactions match with the source documents or not, like sales invoices, shipping notices, and so on, whether the details match or not. If the details match, you know checks were in place. If the details don't match, something was wrong. So those are your tests of controls. You're just testing the control the client says client has. These are not your own procedures. You're not doing vouching, tracing, and all that here. You're not using your own substantive procedures. You're just simply inspecting documents, looking at source documents. You're just testing the control the client says client has. The client says we've got separation of duties, for example. What is a test of control? You observe and just test it. Is there a separation of duties or not? So that's it. That's your test of control. What if the test of control suggests that the control is not working? What should happen? You make an initial assessment, okay, a preliminary assessment of control risk. Once you make that initial assessment of control risk, what happens next? Once you make the initial assessment of control risk, you need to confirm your assessment. If when you confirm your assessment, you find that your controls are not working effectively, what should you do? You should check whether the client has any compensating controls or alternative controls. If the client doesn't have any compensating or alternate controls, its controls are not working properly, what would you do? you would basically move to a predominant substantive approach and use mostly substantive procedures. Okay? So if you cannot confirm your initial assessment, initially you might have thought controls are super strong. When you start testing the controls, you find controls appear to be weak. You try to look at alternative controls, compensating controls. You can't find any alternative controls. What is your conclusion? Controls are weak. You need to move on to a predominant substantive approach. Test of controls for cash receipts, same thing. Occurrence basically means cash receipts are for sales related to accounts receivables. So you've got cash receipts. You're basically collecting your receivables. You've made sales for your receivables, and those are your cash receipts. So are your cash receipts valid? That's occurrence. Completeness. Have all your cash receipts been taken into account? Accuracy, dollar value of your cash receipts. Classification. Have your cash receipts been appropriately classified? Charts of accounts. And finally, have your cash receipts been properly presented, coded, and so on? How would you test controls? Occurrence. How would you know whether the cash receipts that have been generated are for collection of receivables relating to sales? What control would you like to see? You would like to see cash receipts are matched to source documents. What would be a good source document for cash receipts? When you record cash receipts, what source document would you want to rely on? What source document is coming back in the envelope? Remittance advice, right? So match the cash receipts amount with the remittance advice. So you would like to see, first of all, the client is matching its cash receipts on a regular basis against its remittance advice. How would you test that? How would you test that that is actually happening? Take a sample of cash receipts from the cash receipts journal and check whether these receipts match the remittance advice or not. As simple as that. Completeness. Are all cash receipts recorded and deposited? How would you check that? How would you check for completeness? Again, the client should have pre-numbered source documents. Pre-numbered, remember the source document I introduced, pre-list of cash receipts, and so on. So check if the client has a pre-numbered cash receipts, list of cash receipts, and so on. Now, how would you test that? So you're basically saying the client has pre-numbered source documents like pre-lists of cash receipts. How would you check that? That's what you would like to see, but how would you test that? What do you think you would do? You would simply do a numerical sequence check. Just test the numerical sequence to see whether all the items are basically, all the pre-numbered items are following through in a sequence and that there is no missing number in the middle, okay? All the pre-numbered items, pre-numbered documents are properly flowing through and there is no missing pre-numbered document. That is called testing a numerical sequence. Now, potential misstatements that can happen with the sales accounts receivable cycle could be clerical mistakes, employee fraud, misapplication of accounting principles, and so on. With expenditure cycle, however, on the other hand, you've got a lot more accounts. You've got payroll, property, plant and equipment, inventory, and so on. How is it different from a sales cycle? It's different from a sales cycle because in an expenditure cycle, you basically test for payments and purchases simultaneously, okay? So you will simultaneously test for cash payments and the purchases that have been made. Because when you talk about a payment cycle, you're talking about purchases of inventory, purchase of property, plant and equipment, and so on. So you test purchases and payments simultaneously in an expenditure cycle. In a sales cycle, you test your sales and cash receipts separately. But in your expenditure cycle, you test payments and purchases simultaneously. So that's one major difference. The other major difference is because there are a lot more accounts in your purchases cycle, in your expenditure cycle, there is an increased concern about classification of debits. For example, when you talk about selling expenses, your selling expenses could include, what can your selling expenses could actually include? What do you think? Your selling expenses could include?
Sales salaries.
Okay, sales salaries. What else can your selling expenses include? What do you think? Sales, selling. It could include, yep. What else can salaries, sales include? Sales salaries is one. What else can it include? A couple of items, like you could include in your selling expenses, you could include commission expenses, salaries of sales staff, a couple of items, correct? Then you've got, what is the other one? Admin expenses. What can you include in admin expenses? You could include office expenses. You could include tax-related expenses. You could include audit fees. You could include property tax expenses. So all those are coming in your admin expenses. So every expense account has a range of expense accounts categorized under it. And as a result, we basically get this problem of classification of debits. That's a concern with expenditure cycle. Another difference between accounts payable and accounts receivable, or the sales and purchases cycle, is with accounts payable, the problem is of understatements. So you need to detect understatements. With accounts receivable, it is to detect overstatements. That's another key problem there, or key difference. Now you've got the purchases cycle. And with purchases cycle, you've also got a flow chart there. Again, you can see separation of duties there. And you've got the production department, receiving department, accounts payable, and cash department. As you can see in this flow chart, you've got both the accounts, the purchases cycle, and the cash payments department all in one flow chart. You don't have two separate flow charts. And that's what we were basically talking about. You concurrently are testing for payments and purchases. Okay, that's the difference as compared to the sales cycle and the cash receipt cycle. So when you look at this, the first department that is basically involved with the purchases is your production department. What does production department do? The production department basically sends a purchase request to the purchases department. Okay, the production department sends a request for ordering raw materials, finished items, whatever the department wants, it sends a purchase request. And that purchase request is a, what is that called? What is that document called? Have they mentioned it here? It's a purchase requisition. There we go. That's right at the top there. It's a purchase requisition. It's sent from the production department to the purchases department. For a good system of internal controls, we would like to see a centralized purchasing department, a centralized one. If we have different departments making their own decisions, it can increase the possibility of related party transactions. So we want, for the best competitive prices, we want a centralized purchases department. The purchases department then basically sends out a purchase invoice. Okay? It sends out, rather not a purchase invoice at this stage, it sends out a purchase order. Okay? I stand corrected. It does not send a purchase invoice. It sends a purchase order to who? To the supplier. Then it goes through the sales system of the supplier and the goods are received. When the goods are received, then you've got the receiving department. The receiving department at the gate of this factory premise basically checks the items. The receiving department gets a copy of the purchase order and then checks the items that have been received. The items are checked for their quantity and the items are checked for their condition. And that's what's being done by the receiving department. Now, so the receiving department is basically checking items for quantity, for their condition. Once the receiving department ticks yes, then it becomes a liability for who? For this client. Because you've said yes, the goods are all okay, these are the goods we ordered, so it becomes the liability for the client. And that's where receiving department's work comes in, okay? Next, what happens after that? What do you think happens after that? After that, once the goods are received, the goods are matched against the purchase order, then an invoice is basically generated by the accounts payable department. An invoice is generated and simultaneously a journal entry is basically recorded. What is the journal entry? So an invoice is basically there. Where is the invoice? Where's the supplier's invoice coming from, guys? Because in a purchases department, we have a supplier's invoice, correct? Where do you think is the supplier's invoice coming from? It's coming straight from the supplier and it's coming straight into the accounts payable department. Everybody with me? Once the supplier's invoice reaches the accounts payable department, then the journal entry is processed. What is the journal entry? For inventory purchased, inventory account debit, accounts payable credit. And then you've got three documents, three source documents that basically get collected. What are the three source documents? I think the three source documents are mentioned here. And this is an important concept called the voucher system. You've got purchase order, receiving report, and supplier's invoice. Purchase order was basically generated by the purchases department. Receiving report was generated by the receiving department, and the supplier's invoice was coming from the supplier. It was coming straight into the accounts payable department. Once the three documents are there, the three documents need to be matched, and then payment is basically dispersed, okay, to the supplier. And that is, those three documents together become your voucher package. Purchase order, receiving report, supplier's invoice. So then you basically test for controls over purchases of inventory. Again, we are talking about purchases, same thing, occurrence. You're basically worried that the purchases are genuine. Completeness, all purchases, have they been recorded? Accuracy, dollar value, cutoff is what? Correct time period. Classification is correctly coded, and presentation is properly presented. Okay, occurrence for purchases. Are all the purchases for valid transactions? How would you check that? Are all the purchases for valid transactions? What would you like to see? Approval of purchase order. How would you test that? Take a sample of purchases and check whether those purchases are subjected to a proper purchase order or not, a proper purchase authorization or not. That's all you do. So you want to see approval of purchase order, take a sample and test that. Check to see whether there is appropriate authorization for the purchases made or not. Same thing with cash disbursements. It talks about the same things in terms of assertions. Occurrence. How would you see, how would you test whether the cash payments are genuine or not? What would you like to see? What would you like to see the client do to check whether cash payments are genuine or not? What do you think? You would like to see the client is actually comparing the cash payments that are being made against which three documents? The voucher package, purchase order, receiving report, and supplier's invoice. How would you test it? Take a sample of cash payments, and what do you do with the sample of cash payments? Match those cash payments against purchase order, receiving reports, supplier's invoice. Take a sample, reperform. That's it. That's how you test the control. Potential misstatements can happen in the expenditure cycle. There could be a couple of misstatements that can happen. Classic disbursements fraud. I've said this a couple of times now, that when you make cash payments, you need to be careful. The client must have purchase order, receiving report, and supplier's invoice. The three documents are matched, and then cash payment is made. What is a disbursements fraud? Disbursements fraud means fictitious invoices are made, okay? There are fictitious source documents made, and then payments are basically following because of those fictitious source documents. So to check classic disbursements fraud, you need to check what do you need to check? How genuine those source documents which accompany cash payments are. So you need to check whether the source documents are genuine or not, because it's very possible source documents could be played around with by the client entity. And after the source documents are manipulated, payments are made. Kickbacks. What are kickbacks? Now what could happen is, remember how I said when you go and look at this kind of flow chart, we said we prefer to have a centralized purchase department. Why? Because this department controls purchases for the entire organization. If different departments are doing their own purchases, what is the problem with that? Different departments can get into arrangements with suppliers, okay? They might tell the suppliers, you basically provide us with these benefits or these kinds of items, and we will give you a kickback for that. Okay, so those are your kickbacks. You get into arrangements with suppliers, related party transactions. Okay, or you might get into arrangement by telling the supplier, well, it's okay, you can supply the company with goods worth $100, out of which you'll have to give me $25 and you guys keep the $75. So things like that, that is basically a kickback arrangement where you're getting into arrangement with suppliers. Illegal acts. Illegal acts basically comprise of your illegal payments. Sales commission basically to get businesses, it's an illegal act, okay? Commissions to get businesses, they're all illegal acts. Unauthorized executive perks. If you start using companies' assets for your personal purpose, it hasn't been authorized for you to use companies' assets for personal purpose, it is basically an unauthorized executive perk. You can only use companies' assets if you've got the authorization to do so, or if it's a part of your compensation package. Otherwise, you can't. There needs to be appropriate authorization. What is this practice of kitting? What do you think is kitting? Kitting is generally a fraudulent practice where companies engage towards the end of the year. So what happens is, we generally ask client entities a list of their bank accounts at the end of the year. Why? Because companies can open a bank account on 30th of June. Okay? They already have one bank account. I'm giving you a simple example. One bank account in which they had $10,000. The company can open another bank account on 30th of June, and what can the company do on 30th of June? The company can transfer money from bank account A to bank account B. Right now, they've just opened a bank account B. They only have $10,000 in bank account A, no money in bank account B. Everybody with me? So what the company can do on 30th of June, transfer money from bank account A to bank account B. On 30th of June, they can acknowledge the receipt of money in bank account B, but they don't acknowledge the payment from bank account A. So how much money do they now have in the eyes of people? How much money do they now have, basically, in terms of the financial reports? Because they've transferred this money, they've done this transfer, they've acknowledged the receipt of $10,000 in bank account B, but they haven't shown the money withdrawn from bank account A. So how much do you think they appear to have? $20,000, because $10,000 they've shown as received in bank account B, but they haven't shown the $10,000 going away from bank account A. They show the money going away from bank account A the next day, which is 1st of July. Okay, so for 30th of June, their position was artificially inflated, made $20,000 just for that day to make the financial reports look better. And that is the fraudulent practice of kitting. And as a result, we require companies to give us their details of bank statements for the entire year. Okay, selling admin expenses. We generally do very limited tests in the areas of selling and admin expenses. Tests are primarily performed for inventory purchases, okay? So if tests are done for inventory purchases and everything looks good, then we are quite confident that our selling and admin expenses do not have a large amount of material misstatements. What tests we generally perform here? We just perform analytical testing. That means we'll do comparisons and certain ratio analysis to check if the amounts look reasonable or not. That's the main procedure we perform. okay? We generally perform most tests of controls only in the inventory area and simultaneously test the selling and admin area. For selling and admin area, we only perform very limited analytical testing, like comparisons and so on, to check whether amounts are reasonable or not. Petty cash, generally it's not an area of concern because amounts are not very material, but the main procedure, if we feel the amount is material, is to see how the client entity safeguards its cash. What procedures, what mechanisms does it have in place to lock its cash resource, okay? How does it safeguard? How does it protect its cash lying around in the company? Payroll. So payroll, what is the problem with payroll? When you talk about payroll, you're performing two types of tests. You're performing either analytical testing, because how are you paid salaries? You're paid salaries on either a fortnightly basis, weekly basis, monthly basis, yearly basis. How are you paid salary? Not yearly. Nobody wants to wait a year for their salary, right? So it's generally weekly, fortnightly, monthly, correct? You are paid salaries in cycles. So it's easy to perform analytical procedures. You can compare one period with another period. And that's your analytical testing to check whether the amount looks reasonable or not. You can also perform tests of transactions over payroll. When you perform tests of transactions over payroll, one thing that needs to be checked when you perform tests of transactions is a key control needs to be there in terms of separation of duties. That is, payroll preparation must be different from payroll distribution, must be different from people who are hiring payroll, and they need to be different from people who are approving the time worked. So all these need to be subjected to different people performing different tasks. So separation of duties is critical. If that's not there, you already know the area of payroll is at high risk. So if tests of controls are necessary, then what would you like to do? You would like to check, and you're just checking, you're just testing the controls the client says client has. You just check the signed time cards, time sheets, check whether pay rates have been approved, and all of those controls. You're just checking whether client has done the needful or not. Interest expense, rent, lease, and insurance payments. When you talk about interest expense, rent, they are all calculations, okay? So what would you like to see as a test of control? What would you want to do? What do you think? You generally take a more substantive approach. You perform your own procedures. You basically check the terms and contractual obligations or agreements, check the terms, and do recalculations. Okay? You check the terms in the contracts, you check the rates, and you perform your own recalculations. If your amount that you've calculated is close enough to the client's account, then basically it means control risk is low. If your amounts are very different, control risk is high. So you're basically looking at the terms, you're looking at contractual obligations, and performing your own tests, doing your own recalculations. So you're basically interested in understanding the terms of the contract. With leases, leases is a very tricky area because it's very complicated. So in terms of leases, you would like to see that the client is following the accounting standard on leases, okay? The client is basically following accounting standard on leases. There's proper compliance with accounting policies. That's what you need to test. And that's it. Any questions for me right now? All the best. Please start off with assignment 2. It's a tuition-free week. It's not annual leave or holiday. Thank you.
Yeah, I'll answer your routing.